Good afternoon. This is Tom Alexander. It is Friday, April 18th. This is the weekend report for the week beginning Monday, April 21st. Today is a holiday in the U.S., as most of you are aware, or you should be aware. Okay, we have a market that has settled in a little bit from the wild, crazy trading of the previous 2 weeks. Let's take a look at things. Okay. By the way, you can go to the website alexandertrading.com. You can access free information there under weekly updates. It's free. You can get the PDF of the charts that I'm about to show you, some other verbiage that's there, and you can look at past updates, etc. That's alexandertrading.com. Also, if you would like and subscribe, it would be a big help, and I would very much appreciate it. Okay. Let's just go through one by one. The indices are pretty much in the same structural position from an auction market perspective, but there's one market in particular that I want to discuss, and we'll get to that in just a second. But let's look at the S&P. Now, the levels that you see highlighted on the screen are the important levels. They are inflection points for the coming days and next week. I have been positing the idea for over a week now that we would, first of all, that the range would come in and that we weren't going to go to zero in this crash and that we would inevitably get a big bungee jump, and all of those things happen. Now we're balancing. Those of you that are familiar with auction market concepts, there's three phases of market development. There's a trend, stopping price, development. This is development in progress to one degree or another. Now, could we just go straight down from here back to these lows? Absolutely. We all know anything is possible. I will point out, just for fun, that to get to the lows from here, it would be quite a move. So from Friday's close to the lows, it would be an 8+% move. Now, could we do that in a few days? Certainly. I mean, we had a couple days in the past 2 weeks where we had, ranges greater than that in 2 days. But that's a pretty healthy move to the downside. I think it's more likely that we continue to develop to one degree or another. Now, whether or not this is the low extreme of a developing balance area remains to be seen. It well could be. Frankly, the paths of development here, the market path here, there are numerous paths. Uh, I, I don't think we're going to go straight back to these lows. Now, do I think the trend is down? There's no thinking to it. The trend is down. We're making lower lows and lower highs. The conviction in this market has been to the downside. So that's beyond question. This level up here that I have highlighted in red, inside of the blue area. The blue area is a broader level. This is a really, really key long-term level to the upside. If we got through this, it would be really interesting, and I would certainly take a look at things then. I don't think that's going to happen. I think we will see new lows before we see this level taken out to the upside. Now, what happens in the meantime, again, is sort of a question mark. We are doing some balance in here now, but here are your levels. And then let's go to the index. And the index is in the same relative position as the SPX. No big surprise there. The Dow took a huge hit on Friday because of United Healthcare's earnings, and it got hammered, but it's still well above recent lows. Let's take a look at the Russell. And here's the Russell. So the Russell, the SPX, the NDX are all in the same relative position, potentially forming a balance area in the upper half of this ramp range that we had. Now, this is the index to me that is interesting at the moment, the New York Composite. Okay, now the New York Composite is a very broad index of every stock listed on the New York Stock Exchange, over 2,000 companies. But if you notice what we have here, we do have a more classical balance area forming than we see in the other indices at the moment. Look at the closes. Here's a close, here's a close, here are two closes right here, here's a close, and here's a close. So the closes are all clustered together in a really tight area. So this is balance, right? Now let me show you another view of this. This is a balance area. Now let's take a look at the profile view. So here are the last 4 days of trade. This is Monday, Tuesday. Well, I take that back. This is Thursday, Wednesday, Tuesday, Monday, and this is last Friday. Okay, that makes sense. So this is, and basically what you're looking at, each one of these is a day auction. I have this particular profile view divided into 60-minute splits. In other words, each horizontal bar is 60 minutes. And let's combine this into what it actually is, which is one auction. And when we do that, you have this perfect Gaussian shape that pops into everyone's head as soon as you say market profile, right? And here's your high volume node right here. This is where we closed right here on Thursday. So the break of this structure is going to be very interesting, but I think this accurately reflects what the summation of the indices have been doing now over the past several days, which is balancing, following this extraordinary up and down and whippy range. So we've had a contraction of the range, which was expected. We've had volatility come in, and the market calming down a little bit, digesting last week's ramp to the upside. All right, let's take a look at the internals. All right, if we look at VIX, now this is interesting because VIX has come in, but it's still elevated. Now it closed just below 30 on Thursday, but it's been above 30 really for the past 10 or 11 trade days, which is quite elevated for VIX. So there is a lot of room theoretically for VIX to come in and still stay elevated. 20 is a pretty elevated level historically for VIX. And VIX, it hasn't been below 30 by much for the past, well, since the 3rd of April this month. So that's that. If we do continue to bounce in here, I think you will see VIX come in some. If we do go lower early next week, obviously VIX is likely to increase again. VIX closed at above 50 on the 8th. I actually saw it something around 60 intraday. That's quite an elevated level. Let's look at breadth. Now, breadth is not going to be particularly helpful at the moment. It's sloping higher. The 10-day moving average of NYSE advancing issues, which is the red line. The green 5-day moving average is advancing issues. And then down here, we have a histogram of closing breadth. We did have a negative 2,000 breadth reading, which has been eerily rare over the past, I don't know, 8 or 9 months. Now, if we're in a bear trend, we're going to see more negative 2,000 breadth readings, and we're likely to see clusters of them, which we have not begun seeing yet. So we have a long weekend. Again, it's Good Friday in the U.S. Easter is Sunday, and then Monday trade will begin again. And who knows what will transpire over the weekend. The exogenous overhang of tariffs, that's the latest and greatest exogenous overhang on the market that the market is fixated on. From a structural perspective, there's several paths here. I don't think we're going to go straight to new lows. I do think that I would favor the short side of this market against the recent highs. So we'll see if the market stays in this relatively narrow range that it's been in for the past week, or if volatility begins to pick up next week. You guys have a wonderful Easter. I will speak with you again very soon.